Welcome to Educational Insight by File Plan Partners. I'm Bobby Norman. Today I'm joined by Robert Moody from our financial planning team. Robert and I are both certified exit planning advisors, which means we really enjoy working with business owners in growing and selling their business. And in today's topic, I want us to talk about exit options, helping business owners sell their business. There's a lot of different ways to do it. You can do it internally, externally. Today, I want to talk about all the internal options they have to sell or exit their business. So, Robert, why don't you start us off here with some options and also talk about the pros and cons of each.
Yeah, okay. So the first one I want to talk about is intergenerational transfer. So that's where the owner transfers the business stock directly to the heirs, usually their children. And the thing to note here is about 50% of the business owners want to exercise this option, but only about 30% actually do. So let's take a look at the pros and cons. So the pros: business legacy preservation. You know, the business gets to continue. They're passing it down to the next generation. It's planned. It can be lower cost. The owner maintains control. There's less disruption, and there's higher buyer-seller motivation. So let's take a look at the cons. Family dynamics. Maybe the kids don't want to take over the family business. Maybe they're not qualified. The next one is lack of funds, illiquid buyers, lower sale price, key employee flight risk, and then tradition may outstrip good strategy. And then just because it's the path of least resistance, it's not always a path to growth or success. The next one I want to talk about is a management buyout option. So this is where the owner sells all or part of the business to the company's management team. Management then uses the assets of the business to finance a sale of a significant portion of the purchasing price. So some of the pros on that is there's continuity. The buyers are highly motivated. This preserves key human capital. Again, the management team is buying part of the business or all of the business, so they're highly motivated. And then planned, it's very planned, and then can be combined with private equity for additional growth resources. So again, this could be a partial or full sale. So let's look at some of the cons. Management sandbagging, distraction, threat of flight, illiquid buyers, lower price and unattractive deal terms, heavy seller financing, which can be a big negative for the owner trying to get out and get their name out of the business. Managers are not always good entrepreneurs. So those are a couple options. Bobby, I know you wanted to talk about a couple more.
Yeah, thanks, Robert. Some more of the internal exit options that we work and talk with business owners about are sale to partners. Obviously success is closely tied to the existence and quality of a buy-sell agreement with partners. And so obviously it's not available to single owner businesses, but some of the pros of the selling to partners is it's less disruptive. Obviously it's planned. It's well-informed buyers. Obviously, if you're selling to a partner, they know the business very well. And it's also a controlled process. And then obviously lower cost. So you're not having to talk about the expenses of having a third party or shopping the business around. It would be sold internally. Some of the cons of selling to partners are a lower sale price. You usually get a better sale price in the end if you do use an outside seller or a buyer to work with them on that. So then also potential discord with selling to a partner and maybe not others. Another con is competency goals. Again, one thing to look at here is the next generation. Are they ready to take over ownership of a firm? Another con is realization of proceeds is often slower. And so something we work with on that. So a final option that we talk to business owners about with internal exits is sale to employees, sometimes through an ESOP or an employee stock ownership program. That's where the company uses borrowed funds to acquire shares from the owner and contributes to the shares to a trust on behalf of the employees. Some of the pros of selling to employees are obviously the business stays in the family. Also, shares are purchased with pre-tax dollars. It's a taxable gain on ESOP shares, also may be deferred. And then an ESOP is an employee benefit. It can help attract and retain employees. And this often causes employees to think more like owners, and so it helps with productivity. Some of the cons that we see with sale to employees is that it may be more complicated and expensive than some of the other options. It also requires securities registration, exemption, That can be costly. And then also the company is compelled to buy back shares from departing employees. So that can happen at times that may not be beneficial to the company. Then also it's generally suitable for a gradual exit. So for business owners who are thinking an exit over the next 5 to 10 years, ESOPs and selling to employees can be a great option. So if you know a business owner, if you're a business owner yourself and you want to discuss exiting in the future here, we'd love to talk to you about the different options you have. Please give us a call at 5 Plan Partners. Thanks.